Investors are handing back their keys to the bank on multi-million-dollar properties across the United States. Take a look at this office building portfolio in San Francisco. Paramount Group, which is a New York-based investor, is poised to surrender 3 office buildings in downtown San Francisco after defaulting on at least one loan. The CEO said these 2 assets are in workout mode during an earnings call on February 15th. He also stated, "We do not know what an ultimate resolution will look like, and there is a strong possibility that these assets may not be in the Paramount portfolio going forward." And this last statement right here is the key to what is happening in the market as a whole. It says the fair market value of both these properties has dropped significantly below the debt used to acquire them. Both properties have maturity dates coming due. The problem with these properties is they aren't producing enough revenue to cover their debt. And by now, everyone is aware that since the pandemic, a lot of office work has shifted to work from home. So companies are shedding their office footprint and the spaces are just staying vacant. Debt on commercial real estate typically comes due every 3, 5, or 7 years. And at that time, the property is reappraised and the value is reassessed. And if that property is only 1/3 or half occupied, or the rents have declined, then the value of that property will be less than what it was when the investor originally purchased it. So anytime you purchase a commercial real estate property, the bank is only going to lend a certain percentage of that appraised value. And typically that's 75 or 80% of the appraised value. So let's say when you originally purchased this property, it was $1 million. Well, the bank would have given you a loan for $750,000, which is 75% of $1 million. But if your term comes due every 3 years, during that 3 years, you're going to pay down some principal. And in this example, let's say the investor only paid down $50,000 of the principal on that loan. So when the 3 years is up and your term comes due, your balance on the mortgage is $700,000. Well, if that office space is only half occupied, the appraised value of that property is going to be significantly less than what it was when you originally purchased it. So let's say, for example, the property now appraises for $800,000 as opposed to $1 million when you originally purchased it 3 years ago. Well, under the best case scenario, if the bank is still willing to loan you 75% of the appraised value, which is $800,000, that means they would only loan you $600,000 on that property, but you owe $700,000 on that property. Your current debt is $700,000. And that would be the best case scenario, because under the current economic conditions, banks probably aren't even going to lend 75% of appraised value on an office space. They're more likely only going to lend you maybe 65%, and that's if they will even do the loan. Because why would they want to do a loan on a distressed property that isn't even occupied and isn't even producing any income? So what option do these investors have? Well, they just hand the keys back to the bank, just like they're going to do in the case of that office building in San Francisco. Or in some cases, they can actually buy the debt down if they really want to keep the property. So in the example we used, the bank was only willing to lend you $600,000, but you owe $700,000 on your originating debt. You would actually have to bring $100,000 to the table to pay down the debt in order for that bank to loan you the remaining $600,000 on that property. But this is super unlikely. They're likely to just hand the keys back to the bank. And that example didn't even include the fact that interest rates have nearly doubled. So whenever you go to renew your loan, your interest rate is going to double, which means the amount that you have to pay every month to your debt service is basically going to double compared to what it was before. So not only is your office space empty and you're not producing any income in order to cover your debts, but also the debt that you're going to have is going to be double what it was originally. So this is a pretty tricky situation, and this is going to affect a lot of properties. And not only is it affecting office real estate, this is also affecting multifamily real estate. Freddie Mac, a government agency that issues loans on large multifamily properties, reported a notable jump in loan delinquencies. And this is after rents had surged during the pandemic. Rent growth has since slowed and even fallen sharply in some areas. This article also states that part of the reason for these delinquencies is the increase in vacancy rate because of a wave of new construction that is coming online. So I'm actually not sure about their reasoning for these delinquencies on these Freddie Mac loans. For one, these Freddie Mac loans are essentially the best type of loan that you can get on a multifamily property. Now they typically give these to very large apartment complexes, 100 units and up, but the reason why these loans are so good is because they are spread out instead of like the commercial loans I have on my small multifamily properties where it does come due every 3, 5, 7, or even 10 years. You have to refinance it, but it's amortized. The payment schedule is spread out over 20 years. These Freddie Mac loans they're set in stone. So you've got a 30-year amortization or a 35-year amortization. I think they even go up to 40-year amortization. So your payment schedule is over a long period of time. So I don't understand why they're having these delinquencies, to be honest with you. The only thing I could guess is that some people bought properties and they were being overly optimistic as far as what kind of rents they could get. Maybe they purchased this property and it needed a renovation, and at the time they purchased it, rents were actually on the rise. So they purchased the property, they have to do a renovation to it to stabilize it, and during the time of that stabilization, rents actually start to come back down. So now their property is ready to rent and they aren't getting the kind of rents that they thought they would get, because I don't know why else they would be struggling to make payments on their loans. So not only are these payments spread out over a long term, they get a very good interest rate. Typically you can get extremely good interest rates. I know a family member has a agency loan like this, and it was like 3%. 3% loan. Over the course of 30 years, you shouldn't be struggling to make your payments. So if this type of loan is having loan delinquencies, there's going to be a lot of problems for investors. This is essentially the safest kind of loan that you can get on a multifamily property. But when FOMO strikes, everybody's calculated risk and conservative viewpoint just goes out the window. And as far as their other reason for these loan delinquencies, which is all that new construction, all those new apartments coming online, I'm not too sure about that either, to be honest with you. Because in my area surrounding some of my properties, I actually have some smaller multifamily properties, and surrounding it, maybe within 1.5 miles to 2 miles, there's probably 400 new construction units coming online. And the interesting thing about these new construction units is their price point. So take a look at this. This is a new construction property that's probably 200 units, and it's less than 1 mile away from my buildings. Actually, it's a couple blocks away from one of my properties. Their starting price per unit is $1,500, but the average one bedroom in my city is $836 a month. So I'm not really sure how a new construction apartment unit, which is double the price of the city average, is going to lower the rents on my existing renovated one bedroom apartment. Now, I know that there is a demand for newer apartments. People like all the amenities that come with it, but at the same time, I'm not exactly sure how rents are going to be greatly affected by these new construction units. So even though I'm skeptical of some of these statistics, they are statistics. They are showing that there's delinquencies, they are showing that rents are coming down, and they are showing that property valuations in turn are on the decline. So whatever the reasoning might be, something is causing these owners to be delinquent on their payments to the banks, which could inevitably lead them to handing their keys back to the bank, just like they are for office buildings, which is actually happening. This isn't only secluded to office real estate. Take a look at this. WS Communities hands keys back for $1 billion debt on LA apartments. One of the biggest landlords in Los Angeles is handing over the keys to lenders for nearly half of its Los Angeles County portfolio. So this isn't the first article I've seen of this. I saw one maybe 6 months ago about a property owner in the Sun Belt somewhere that handed back the keys on like 4,000 some apartments. And I actually have a monthly landlord meeting for one of the neighborhoods that I'm a part of that I have some small apartments in. And there's a property manager that manages a lot of large apartment complexes in the area. And she had told me that she had been contacted by some banks about her taking over some of these apartment communities that had been handed back to the banks. I'm in Tulsa, Oklahoma. This is a very small metro. And if it's happening here, this is a super strong market, then that's not a good sign for the rest of the United States. But she said the reasoning for this, at least from what she could gather from these banks, was because of bridge debt. This, interest-only type loans, this type of bridge debt that you get when you're going to renovate a property, and then when you're done renovating it, you actually get a fixed term with the bank. Well, they got this bridge debt when interest was really, really cheap, when money was really cheap. And when they finish the apartment complex, finish renovating it, they go to get a loan in the bank, and the bank says, yeah, we can give you 8 or 9% loan. Well, those numbers just don't work. If it don't make dollars, it don't make sense. So these people just had to hand the keys back to the bank. You might not be seeing it in mainstream media, but it is happening. And this has greater effects on the economy. This is why this is a problem, because this leads into bank failures, which in turn leads to recession. I mean, all of this is a snowball effect on the economy. So anyways, the best way for you to make sure you're not affected is to stay informed. So please smash that like button, click the subscribe button, and as always, till next time.